Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's program, what happens when two investors meet in a dark alley and their portfolios collide? Portfolio Wars. A contest of who has the better built and stronger investment portfolio. On today's show, it's going to be Chris versus Rocco. Rocco's 55 years old. He's got a $671,000 investment portfolio. And Chris has a portfolio that is worth over $750,000. How do they do? Who's got the better built portfolio? Who wins the war? You're going to find out on today's show. Also coming up, my program guest on today's show will be Sylvia J. She's at Direxion Investments. We're going to be talking about why the U.S. stock market has been doing better versus the rest of the world. We're also going to talk about interest rates and ways to play that particular trend of higher rates. That's something we've seen over the past several quarters, and how to capitalize on that. So stay tuned for that. If you'd like to join us to talk about anything on your mind, a particular stock, mutual fund, ETF, or investment strategy, you know the drill. 844-305-7800. Give us your first name along with your city and your ticker symbols. You can also tweet the program live at Index Show. That's where you find me on Twitter. So taking a look at market action this past week and seeing what happened in terms of market performance. Now, if we take a look at just the broader S&P 500, it rose almost 1%, and it reached once again a record close. A record close. We've got the benchmark index now ending at almost 2,900, and a big part of the advance came on Friday as Fed Chairman Powell signaled that while the U.S. economy looks strong, that the central bank does plan on keeping its focus on raising interest rates gradually, and investors, I guess, interpreted that quite positively, that the broader U.S. economy is in good shape. We've told you that before on this program a number of times, that corporate earnings are strong. That's how they were for the second quarter. That's how they'll be for the third quarter. And that is what is obviously contributing to rising share prices. But also we still have, despite rising rates, a somewhat accommodative Fed, and that's certainly positive, but we also have momentum on the upside for stock prices, bullish momentum, and that continues. You take a look sector-wise, key sectors that continue to lead and dominate in terms of performance, technology, and healthcare. But we've also got other important industry sectors like consumer discretionary also performing well. This past week, Target, which is a member of the consumer discretionary sector, posted better than expected quarterly results for the second quarter, and that was good enough to send Target and its share price surging over 5%. So that was in the consumer discretionary sector, ticker symbol XLY. On the downside, there has been some gloomy things happening in that sector. Consumer staples, which has been an underperformer. XLP is the ETF that tracks that area. We've got Philip Morris, ticker symbol PM, falling just over 6% as the stock was downgraded by Jefferies and Company. So that is what's going on sector-wise. Broader big picture view of what's going on globally, U.S. stock market ahead by just over 9%. That continues to outperform the rest of the world. If you compare that to emerging markets as well as developed market stocks, both of the latter areas are in negative territory on a year-to-date basis. When I say year-to-date, I mean since the beginning of the year up until now, through the market close of August 24th. So U.S. stocks on a relative basis outperforming their international peers. Total U.S. bond market has been pretty much flat, down modestly about 1%. And then global REITs, REET, ahead by just over 2.5%. And then commodities as a group are down almost 2%. So that's your big picture view. Asset class wise, U.S. stocks continue to outperform. And then some of these other areas are down, but just down modestly. And I'll make that as a major point that although the losses in some of these areas, like emerging market stocks and developed market stocks, as a group, big picture, the losses have been modest. Now, if we drill down and we look at it on a closer basis, micro basis, then you will see that some of the losses have been a lot larger. Specifically, stocks from China, stocks from Brazil, much, much deeper losses. Those areas in a definite bear market. And so, but on a big picture basis, overall markets are behaving quite well. 844-305-7800 is the number. We're here if you'd like to join us. Coming up a little bit later, Sylvia Jablonski at Direxion Investments will be joining us, and we'll drill down a little bit deeper into what's going on in terms of market performance and some strategies that you can employ in your own portfolio to participate. Also, we're going to talk a little bit in that interview about defensive investing, and certainly some of us are a little bit queasy in the stomach when we see stocks at all-time highs once again. And so defensive strategies for those of us that want to still make money but at the same time don't want to get creamed. So the main headline for today's show is what happens when two investors meet in a dark alley and their portfolios collide. Portfolio wars, a contest of who has the better built and stronger investment portfolio. So as most of our listeners know, at least the longtime listeners, one of the hallmarks and trademarks of this program has been portfolio report cards, where I analyze and grade portfolios of listeners, portfolios that you send to me by going to portfolioreportcard.com. That's where you make the official request, and you give me a little bit of data, a little bit of background on who you are and how you invest. And then I take that data and I begin to drill down and analyze and grade your portfolio in 5 areas: the cost of the portfolio, the diversification, risk, taxes, and then performance. And then I give you a final report card grade of A, B, C, D, or F. So on today's show, we're going to do this Rocco versus Chris. And that's Rocco. It's not Rocky. I know he wants me to call him Rocky, but it's Rocco. And so we're going to look at each one of their portfolios. We're going to compare and contrast and see who's got the better built portfolio. Is it Chris or is it Rocco? Now, they both are about the same age. They're both in their 50s. Rocco's got a $671,000 portfolio. Chris's portfolio is slightly larger. He's at just over $750,000. But we're going to see who's got the better portfolio in terms of cost, diversification, risk, taxes, and performance. And then we're going to announce at the end of the show a winner, a Portfolio Wars winner. So we've got a lot to look forward to. You've got a lot to look forward to on the show. This is going to be fun. We always love to see battle of the portfolios, and we're going to see who wins this battle. Is it going to be Chris or is it going to be Rocco? So stay tuned for that. We're here if you'd like to join us, 844-305-7800. I'm Ron DeLegge, and I'll be right back.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
All right, welcome back from the break. This is the Index Investing Show. 844-305-7800 is the number. Just by way of reminder, if you ever miss our regular radio broadcast, you can pick up our podcast. It's available at indexshow.com. You can also find us on Google Play as well as iTunes. Just search for the Index Investing Show and you shall find us. We're also on Twitter. At Index Show is where you find me there. And on the Twitter feed for this past week, very busy week, a lot of good tweets. I guess my quote of the week is from Jim O'Shaughnessy, and it's a retweet. He said this: markets change minute by minute. Human nature barely changes millennium by millennium. There's your edge. Isn't that a great quote? I've got another quote, a retweet by John Borman, and my comment was, the stock market pundits are proven wrong again. It's a beautiful chart of the S&P 500 heading up since July of 2012. I guess it's what is this? It's a 6-year chart looking at the S&P 500. And each step of the way, it's got what the pundits have been saying about how the stock market's going to crash. Paul Farrell, Ron Paul, Henry Blodgett, Mark Faber, Harry Dent, Bill Gross, Robert Wiedemeyer, all of these market pundits, Jeffrey Gundlach, saying the market's going to crash each step of the way. And each one of them has been badly, badly wrong. Shows you why we need to pay attention to prices and not opinions, because prices are what determines the winners. It separates the winners from the losers. Prices are how we make money, not opinions. I also have another quote from Eric Balchunas. He quoted Fidelity, Johnston, or the Johnson family. Is it Johnston or John Stone? He says John Stone of Fidelity. I think he means Johnson, who says that the vast majority of our actively managed funds at Fidelity outperform the indexes and ETFs. My comment to that, that's only true if Fidelity's marketing team cautiously cherry picks its time frames. That's when that's true. If they don't cautiously pick their cherry pick their time frames, then it's not true. But we know the marketing team always does that. They cherry pick the exact time frame to show their actively managed funds outperforming the indexes. And of course, it paints a distorted picture. Also, a rebroadcast of last week's program, or actually 2 weeks ago, we talked about the demise of physical gold ownership. And so you can listen to that on our Twitter feed. I've got a link to that at Index Show. Again, is the Twitter feed. So taking a look at what's going on for today's program, we're doing portfolio wars, where we've got two portfolios that are battling each other. One is from Chris, and the other one is from Rocco. And so each of them I've done portfolio report cards for, and now we're going to see who's got the better portfolio, because this is portfolio wars, a contest of who built it better. And so just to give you kind of a heads up match of what we're looking at, Rocco's 55 years old. He's got 11 holdings. His total value is $671,000 and change. He's got 6 ETFs, 4 stocks, and 1 mutual fund. Chris, on the other hand, is 52 years old. His portfolio is $757,000 and change, and he's got 20 holdings in his portfolio, made up mostly of stocks, mutual funds, and a lot of closed-end funds. And his goal, Chris's, is dividend income with moderate appreciation. Rocco, he told me that his goal is also the same. He wants dividend income with some appreciation. So there is some similarities, although the portfolios are different. There is some similarities in terms of the goals, what each of them are looking for. They're also in the same general age group. So I think that although the portfolios are different, although the investors are different, that this is a good head-to-head match to see who has got the better portfolio. So let's begin by taking a look at what the holdings are. So in terms of Rocco, his top three holdings are ticker symbol SCHB. That's the Schwab an ETF that tracks the total U.S. stock market. Got about 22% of his portfolio there. Ticker symbol WDIV, which is a global dividend ETF from State Street Global. He's got about 18% there. And then he's got 30% of his portfolio committed to bonds via a mutual fund called the Loomis Sales Bond Fund, ticker symbol LSBDX. Those are the top three holdings for Rocco. Now, Chris's top three holdings are quite different. He's got as his number one holding ABR, which is called Arbor Realty Trust. That's a real estate investment trust. He's got 8.1%, just a little over 8% of his exposure there. Actually, that's his number two holding. His number one holding is ticker symbol QQQX, 8.3%. That one owns or sells covered calls on the NASDAQ 100 index. And then his next big holding is USA, which is called the Liberty All-Star Stock Fund. This is a large cap mutual fund. It might be a closed-end fund. I got to check that. But it uses what we call a fund-of-fund approach. So it's divided among different money managers. There's 3 value managers and 2 growth fund managers. And this up Chris's top 3 holdings. So he's really got a little bit more of a concentrated position versus some of Rocco's top holdings. So let's begin with the first grading category, which is cost. Who's got the advantage here in terms of the portfolio cost? Well, most of Chris's portfolio, the bulk of it is made up of closed-end funds. He's got a number of Eaton Vance funds, ETO, ETV, ETY, EVT. These are all closed-end funds that have pretty good dividends. He's also got some non-Eaton Vance closed-end funds, like ticker symbol CII. That's a BlackRock domestic and foreign stock fund that sells puts and covered calls. And also he's got CSQ, which is Calamos closed-end fund that invests in stocks and convertible securities and high-yield corporate bonds. But the thing here, though, is we've got to pay attention to not just what the yields are for our closed-end funds, but what kind of expenses we're paying on all of these funds. So the expense ratios, if we compare them to Chris's portfolio with Rocco's, Chris is paying on average about 1.16%. Chris, by the way, makes 6 to 12 trades per year. And then Rocco, his expense ratio is 10 basis points or 0.10%. That's his average. He does about 3 to 4 trades per year. And you look at his portfolio, Rocco, he's got mostly low-cost index ETFs. He's using Schwab. He's got the Schwab funds, U.S. stocks, emerging market stocks, REITs, and he also has a few individual stocks. So in terms of cost, Rocco wins this battle He beats Chris. We've got several more categories to go. Diversification, risk, taxes, and performance. Who wins? Find out when I come back.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Pleased to have with us Sylvia J. She's Managing Director at Direxion Investments. They oversee almost $14 billion in total assets in a lineup of mutual funds as well as exchange-traded funds. Sylvia, welcome to the program. Great to have you back.
Thanks so much for having me.
Compared to the rest of the world, the U.S. stock market, as you know, is outperforming, and that's been good for traders in Direxion ETFs that offer 2x and 3x exposure to U.S. benchmarks like the S&P 500. So tell us, why are U.S. stocks doing so well?
Well, I think what we've seen over the last almost decade now in the longest running bull market here is essentially what looks like a continuously strengthening and today strong economy. We've seen good jobs numbers. We've seen, new tax cuts coming into play that are, widely expected to impact earnings in the next year or so and potentially have impacted this sort of last round that we just went through. And, even if you just take tax as an outlier, you're talking about some, massive bottom line savings when you have companies moving, business back on shore and going from 35 to 8 to 15%. But, what we've really just seen is, I would say, a sense of a strong economy, and it's been good to the U.S. and particularly U.S. small cap to date.
And others may want to, besides doing that, take a more defensive posture towards the market. So what are some strategies for defensive traders or investors in this kind of climate?
In terms of defensive trades that we're seeing employed, there are a few. If you're of the camp that, the S&P is at all-time highs and, perhaps are sort of, fearful of this war between, tariff talks and trade wars versus a strong economy and you want some protection, there's a way to just hedge your S&P exposure by using an inverse S&P 500 ETF. We have one at Direxion. The ticker symbol is SPDN. So it's we do see some advisors and family offices with more, sort of a longer-term asset allocation models throughout the year that have, a percentage of their portfolios hedged with that ETF. The other thing that we see portfolio managers doing now is reducing duration or hedging rates. We've been talking about this bond bubble burst. You and I have even talked about this bond bubble burst a couple times now. And I think what we are seeing is that we have had a couple of rate hikes and rates are more likely to rise than they are certainly to fall. Perhaps we might have extended periods of flat rates, but increased rates is what I would expect. And in that case, you could use an inverse ETF like a TMB, 3 beta daily inverse 20-year Treasury ETF, which has a duration of basically negative 51. So it's a significant hedge to a portfolio and performs well as bond prices fall and interest rates are hiked.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Sylvia J, Managing Director at Direxion Investments. Direxioninvestments.com is the website. Go there for all things ETF. Direxion investments.com. Now, you mentioned interest rates. Jamie Dimon, the CEO at JP Morgan Chase, cautioned recently that the 10-year U.S. Treasury yield could hit 5%, and many investors, he believes, have underestimated that possibility. So what happens? I mean, would it be a disaster for markets if we see a 5% yield on the 10-year U.S. Treasury? What are your thoughts?
You know, I definitely think we experienced some chaos in the markets, and you know, you would certainly see this reflected in you know, bond ETFs, fixed income mutual funds, and you know, in general equity markets. But I think that, you know, like anything else, there are a lot of short-term plays right now and a lot of short-term sectors to look at. And you know, if that happens, if there is a spike in interest rates, you can certainly benefit from, you know, the bond prices falling by using these inverse ETFs, like you know, you can use the 3 beta 20-year plus. You can use the 3 beta 7 to 10-year. You know, there are inverse products in that space. So it's you know, there's always a way to sort of benefit from whatever is going on in the markets and in the short term for tactical traders. And I would look at some of those inverse treasury ETFs if sort of that happens.
So what is behind the monster move in some of these areas? I mean, take your pick, whether it's technology, healthcare, or biotech. What do you see happening?
Yeah, sure. I'll start with healthcare just because it's been a hot topic this morning, in particular here at Direxion. But we've got Cure, as you mentioned, and you know, if you just look at the performance month to date, it's up about 7%. And actually, interestingly enough, there's an ETF called Pill that I think, you know, might not be as familiar to some, and it's a 3 beta pharmaceuticals, and that's up 10% month to date. And you know, what's going on there? I mean, just look at if you look at United Healthcare and CVS, for example, just take those two names. You know, they are they're two components of the Fortune 500, you know, top 10, you know, top revenues, top market cap. Those names have been doing really well, and I think what's pushing that space is a lot of M&A, a lot of offshore money sort of coming onshore, tax cuts, you know, FDA approvals and pre-approvals for various drugs, and you know, for all sorts of biotech companies. You have increased cash flow. You have this integration of pharmaceuticals, insurance, client care. You know, healthcare has just been a top performing GIC sector this year, and you know, a lot of investors are essentially looking to get exposure to that. So it's sort of been, you know, a hot trade this year. And you know, tech, it's probably, you know, what everyone's kind of been hearing on a daily basis. You've got massive performance from giants like Amazon, Apple, Microsoft. You know, throw in some of the semiconductors like NVIDIA and AMZ. I mean, you've got these just massive top performers, you know, general growth in chips, graphics, gaming, technology, and just like a, you know, quick fun stat, if you just look at NASDAQ versus S&P, you know, you've got about an 8% spread in outperformance there. So tech and healthcare have really been sort of GIC sector darlings this year, and we've seen some flow into Cure, to ECL, and you know, sort of like Pill and LabU over the last couple months for that reason.
Yeah, those have been really, really good performers. Innovation continues to be one of the hallmarks within the ETF marketplace. Just real quickly, if you can just tell us about Portfolio Plus ETFs, which I think are one of the latest inventions that really help long-term investors to capture maybe a few extra basis points on the upside. Tell us more about that.
Yeah, sure. Well, you know, we sort of see the world in a few ways. You know, you've got traders that are tactical, sophisticated, looking for these short-term opportunities and you know, sort of daily moves, and they use the 3 beta ETFs like TechL and you know, Cure. And then you've got a crowd in the middle that's sort of like more macro themed and you know, long short strategies, DM versus EM, that kind of thing. And then, you know, the third world that we tend to cater to is the long-term asset allocators. So they run ETF models, and they use different building blocks to gain exposure to specific sectors that they believe in. And, you know, they're really looking for, you know, long-term buy and hold opportunities, and they're not tactical traders. So we launched the Portfolio Plus for that last crowd. And, you know, I'll just give you a quick example. You know, the idea here is that really actually, over time, if you look at the S&P 500, it sort of beats us all. It beats most active strategies, to the tune of, I think 90% was the statistic that I read somewhere. It's probably even a little bit higher than that. But if you run it out past the last 20, 30 years, S&P, is sort of net performance is positive. The periods of volatility are sort of well known and small. And if you're invested in it over time, you tend to perform well. So our thesis was, why not add a little bit of exposure to that with 25% exposure to a particular index, and you don't have a significant risk associated with that. So quick example, if you're a portfolio manager, you have exposure to large cap, small cap, emerging, developed, and right now you're thinking trade wars, tariffs, what's doing really well, small cap, but I don't have any money to free up. How do I increase my performance or my exposure to that sector? I can use an ETF like PPSC, which is a small cap portfolio plus ETF, and get an extra 25% for every dollar that I invest. So it's just a way to enhance what portfolio managers do really well.
Very good. Well, thank you very much for sharing these awesome strategies and ideas with us. Again, you just heard from Sylvia Jablonski at Direxion Investments. I'm Ron DeLegge. We'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, that was a great interview there with Sylvia at Direxion Investments. We talked about a lot of different themes. For those of us that want to be a little bit more defensive in our investments, we talked about ticker symbol SPDN. That's S, P as in Paul, D as in David, N as in Nancy, SPDN, as a ETF that aims for 100% daily opposite exposure to the S&P 500. So if the S&P 500, for example, on any given day is down 1%, SPDN is designed to increase by 1%. It's the type of ETF that you would use as a defensive hedge against future market declines. And so I think that's the type of ETF that would be a good defensive play for those of you that are expecting a fall or want to protect against that possibility. I would not be using, by the way, any 200% or 300% bear market ETFs. In other words, leveraged ETFs that aim for opposite exposure to the S&P 500 or the NASDAQ or to the Dow or to stocks in general, especially stocks in the U.S. I would not be using, again, leveraged ETFs that aim for double or triple daily opposite exposure, because of the fact that we only want to use those types of funds in a market that's trending sharply in the same direction that we're trading. So that's the only time and place, I believe, for 2X and 3X ETFs. You're trading in the same direction that market is trending in, and that trend has to be very strong. And so right now the trend in stocks is sharply up. So the time and place for those 2X and 3X funds is to the upside. You want to be trading the bull ETFs. And as for the bear ETFs, when that trend changes, and eventually it will, when it reverses and it goes from a market that's bullish to bearish, and that trend becomes very established and the market trend is down and it's sharply down, that's when it'll be time to use those 2X and 3X ETFs that are bear ETFs. But for now, I think SPDN is a good way to, again, hedge for any decline, upcoming decline in stocks. 844-305-7800 is the number. This is the Index Investing Show. We're here every week at the same hour, teaching you the birds and the bees of successful investing. At Index Shows, where you follow me on Twitter, you can tweet your questions there, as well as comments. You can find our podcast at indexshow.com or on iTunes, as well as Google Play. And when you subscribe, also please post a review of the program. Let us know what you think. Getting back to portfolio wars, that's been the headline of today's program. We've been talking about Chris versus Rocco, not Rocky, Rocco. They both have pretty big portfolios. Rocco's at $671,000. Chris is at $757,000. And each of them in their 50s. They have similar investment goals. They want dividend income with some moderate appreciation, a little bit of growth. But they're going about this quite differently. Chris is mainly using closed-end funds with high dividends or high dividend yields. And Rocco is mostly using ETFs. That's the bulk of his portfolio. He's got Schwab ETFs. He's got 4 of them. He's also got a Spider ETF. And then he's got a few individual stocks in the mix, like Apple and General Electric. But again, the approaches are very, very different. We already looked at the cost of the portfolio. Rocco won that particular battle. He's got the lower cost portfolio. He does fewer trades than Chris. So let's take a look at the next grading category and see who wins the war of portfolios. The next category is diversification. So all of us should know that a properly diversified portfolio has exposure to all the major asset classes, and it should do that using funds that are proxies for those asset classes. So in this case, what are the 5 major asset classes? Does any of us remember this? Well, in case you forgot, the 5 major asset classes are stocks, bonds, commodities, real estate, and cash. Those are the 5 major asset classes. So the question then becomes, well, how does Rocco's portfolio look? How does Chris's portfolio look when it comes to diversification? So let's begin first with Rocco. He has exposure to stocks. That's good. He's got ticker symbol SCHB, CHE, CHD, and also CHH. So he covers himself right there with exposure to stocks. He's also got real estate, also known as REITs. He's got bonds, and he has a little bit of cash. The only asset class I see missing in Rocco's portfolio is commodities. So he does miss there. That's a strike against him. But I also noticed, too, in Rocco's portfolio, there is some what we might call duplication in his portfolio. So, for example, he's got exposure to ticker symbol SHB, which is a all-cap U.S. stock fund. In other words, it owns large, mid, and small company stocks. But he also owns QQQ, which gives him exposure to the NASDAQ 100. And you'll see many of the same stocks inside SHB are also duplicated in QQQ. And then on top of that, he also owns Apple and GE and Pfizer and Amgen, which are, again, duplicated positions already owned in the very ETFs that he owns. So there's a lot of duplication happening, and from a diversification perspective, it's quite unnecessary. And so that does not bode well for Rocco. But overall, big picture, I think he does a pretty good job in terms of diversification. He certainly needs to make some modifications, but he misses one biggie, that's commodities. In terms of Chris's diversification, he has exposure to stocks. He does have exposure to real estate. He's got exposure to bonds. You take a look at some of the holdings. I mean, he's got these closed-end funds, and a lot of them use not what we would say traditional fixed income like bonds, but they're using maybe things like convertible securities, which are hybrid securities, kind of a mix of stocks and bonds. He's also got some closed-end funds that own high-yield bonds. So, and then also I mentioned REITs. He's got ticker symbol NRZ, as well as ticker symbol. His biggest holding is ticker symbol. One of the biggest holdings is that Arbor Realty Trust, and that's a very big holding. That's ticker symbol ABR. So he's got the exposure to these areas. He does miss commodities, and he does not have from what I see, any cash in the portfolio, so that's 2 missing asset classes. But the thing about Chris's portfolio that's inferior to Rocco's is he doesn't really have any index funds or ETFs that serve as broadly diversified proxies of the asset classes he's tracking. So, for example, he doesn't own any broadly diversified REIT ETFs, which would give him exposure to real estate in a broad way. He's going about this the opposite way. He's getting his exposure to REITs in a very focused, concentrated way with just a couple of individual real estate holdings or names, and that could be very, very risky, but moreover, it doesn't really cover the entire asset class. So who wins the battle, Chris or Rocco? Portfolio Wars continues. On next week's program, we're going to take a look at risk, taxes, and performance and give a final grade of Chris versus Rocco, who wins. Be sure to tune in on next week's program. And you know the drill. Be here or be nowhere.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.